All right, Peter, you up here?
Yeah, good morning or good afternoon. How are you doing?
Good. How are you doing?
I'm surviving. As you may have not seen, I posted about the weather here in Calgary. It's still like minus 12 today. Feels wrong in March to be freezing my ass off, but there you have it. So the joys of being in Canada.
Oh yeah, I hear you, man. I'm in Minnesota. We can smash every other day with snow. Fun stuff,
Absolutely.
man. So I know you don't got a whole bunch of time here, so we're just gonna go straight into it. We're gonna go live here quick. They can come in on YouTube, but just want to go ahead and start talking to you a little bit about everything that's going on here. Obviously, you got all these bank collapses. That's gonna be the first thing I want to get into. But let's just go straight into this. What is your opinion right now on SBV? And the downfall that we're going to see here with all these startup tech companies and everything else.
Yeah. I mean, I've been trying to, to be frank, this thing came out of, well, I hate to say it didn't come out of nowhere, but we all know that the financial system in the U.S. is, and the global system for that matter, is on a shoestring. But like I said, this particular bank, like we were all focused on Silvergate and, what it meant for crypto. And so the regional bank issue, to be honest, I was thinking it would be like one of the bigger players like Credit Suisse that would bring things down. So what happened? What happened here? If I scroll through LinkedIn, and I've been posting a few things on LinkedIn this week about it, and I get all kinds of comments, and I have some fairly interesting people that have been replying, and I've seen some other posts. Some will say, "Oh, this is an isolated event. The U.S. financial system's fine. You're all worrying about nothing. It's not a systemic risk issue." And then you got other guys saying, "Oh shit, it's a huge systemic risk issue." And I mean, if you take a look even at a non-disinterested person like Bill Ackman, posting on Twitter today, basically pleading for he's pleading for a bailout before. Now he's pleading for some sort of a, you know, get someone to take, get JP Morgan to buy him out over the weekend. So there's clearly some significance here. So if you want to, give me some leeway here, to go through what happened here. So again, it's a longer term problem with the entire global system. The Fed has been distorting interest rates aggressively since 2008. It's created an incentive to take too much risk in almost every asset market, but particularly financial institutions have been overly complacent in terms of managing their interest rate duration gamma risk. The Fed says we're going to be low for longer. They were quantitative easing several times throughout 2008 to 2012. They tried to start normalizing the Fed's balance sheet in 2017. They didn't get very far before they had to reverse, and then of course they had the repo blow up in September 2019, which probably was caused by JP Morgan, by the way. And then yeah, like the Fed had to sort of create new repo facilities and bail everything out. And so the response, for the last 12 years has been, the Fed's going to keep interest rates low and volatility low. So we can take these ridiculously large bets and leverage ourselves and give lots of money to Citadel and whoever else that wants money. And you've had this like total disregard for risk management. And, I remember when I was still at Scotiabank in 2018, I was looking at what was going on globally, and some of the things in Europe were insane. Like you have a 30-year German bond trading at a negative yield, and you even had at one point Greece, which had been basically about to be bankrupt in 2014. In 2020, I believe, early 2020, was able to issue a short-term bond at negative yield. It's like, how the hell is Greece able to issue a bond? Who's buying this stuff? And that's what people really weren't paying attention to, is who's buying these bonds. And I've been saying for the last few years, like if rates go up, there's a huge problem here because you're going to have a huge mark-to-market loss. If you bought a German 30-year bond at a negative yield, your duration exposure is huge. If that yield goes positive, you're going to get nuked. And similarly, U.S. Treasuries never went negative, but they certainly got low. A 30-year mortgage, 30-year Treasury was, I think less than 2%. And take that along the credit curve, then you got junk bonds that were trading below 4%. It's like, this is insane. So people were taking huge risks with duration bets and also with credit risk, but mostly duration risk. And I was wondering, well, the Fed started aggressively hiking, in one of the reasons I think the Fed was actually trying to gaslight us is because they were aware of this problem, that there was far too much exposure to duration debt on the financial institutions' books. And so they said, yeah, we don't need to hike. Don't worry, inflation is transitory. It'll go away. Because really, if they can convince people inflation is not a problem, these people don't go to Walmart and stock up on toilet paper, whatever they're doing, then pressures might not go up, and therefore the Fed doesn't have to act. So they were trying to gaslight us to prevent inflation expectations from building. But the fact is that the damage to the supply chains was so huge that the inflation was going to get out of control anyway. And so they finally realized that. And of course, 2022, they're still quantitative easing though into July of 2022. That's the ridiculous thing. They only stopped in July. For the first 6 months of last year, they were still quantitative easing, even though they said they were going to be done. But finally, in July, they start quantitative tightening, which they're taking liquidity out of the system, and also they started hiking in March, but they started to really get serious about it in July. So what you've had is like a very quick rise in interest rates, historically speaking, from a very low base. And this is also a Fed that had said, yeah, low rates for longer. Don't worry about. We're not going to hike until like 24. So they lied. Well, they didn't lie. They were wrong in their initial forecast. So anyway, this has caught everyone off guard. And so when I was talking about this financial Armageddon, it's like I've been screaming on LinkedIn for years. It's like, hey, if Treasury yields go up, this is going to be a big problem. And yet we didn't really see much until like the Treasury got to over 4% back last fall, and then you started to see like some of the bigger equity names get totally whacked, like Amazon, Meta, huge after market losses. And it's like, what is this? This is margin calls going off. This is people that were basically had a long bond fund, long equity fund. Their bonds were getting clobbered, and they had to make collateral calls by selling their equity. Similarly, like sometimes you see like gold gets nuked when it's like inflation is going up. Why is gold getting nuked? It's like because they need to sell their gold for collateral calls. So anyway, the big problem here is I didn't understand why the problem wasn't showing up more. I mean, the market seemed to be taking higher treasury rates somewhat, well. And now what happened was the FDIC came out with a report a week ago, and I didn't really catch on to this. This is something I wasn't aware of, to be honest. It feels like I should have known it, but the banks have a special. Okay, so going back to 2008, the whole financial system was under strain, and to avoid this happening again, the Treasury, all the regulators said, okay, banks, you need to have more capitalization. So you hear about Basel II, and then so one part of Basel II was capital adequacy requirements, and so every country has different regulators that will force Basel to make sure you have adequate capital. But the main thing in the U.S. is they said, okay, well, yeah, you've got to have all this capital. Well, if we need this capital, we can't really loan it out, and that's expensive for us. I said, okay, well, you can hold bonds. Okay, well, that's great, but we can sell those bonds if we need the cash, but those bonds are volatile. Okay, well then that's fine. You can have this special category on your balance sheet called hold to maturity. So assumption is you won't be selling them, you'll just be buying them, and you'll hold them to maturity, and you don't have to mark to market the losses on your balance sheet or your income statement. So free right to buy as much bonds as you want, so your capital adequacy ratios are intact, and you look good to regulators. But meanwhile you're accumulating all this interest rate risk. And well, if you hold the maturity, it doesn't matter what the bond value goes up and down. But this is the kind of stupid part, right? It's like if the bonds are there for liquidity purposes, the assumption is they might need to be sold. But if you're gonna, yeah, okay, that's great. If in the previous decade when the Fed was cutting rates and Europeans were keeping rates near zero and they were buying bonds, everyone's buying bonds, and the price of bonds was such that the yields were going negative, then you didn't have to worry.
Startups had access to capital, which they now don't with the rates, which is why that is specific bank went down as well.
Yeah, and that's where we get to it here. So the problem is the Fed again aggressively hiked rates not way too quickly. They hiked a lot quicker than they ever have, and a lot of these banks have been stocking up on long duration bonds, 30-year treasuries. And in SVB's case, it was even stupider. They bought mortgage-backed securities. So they're even more volatile than treasuries because they're government insured through Fannie Mae or Freddie Mac or whatever, but they have convexity risk. They have basically prepayment risk. So they have all the risks associated with a mortgage, because mortgages aren't as easy to hedge as treasuries. But anyway, they were loading up on 30-year mortgage-backed securities. It's just insane. So this is a case of and so the Fed was raising rates. And what happens with someone like JP Morgan is they don't need deposits. They don't care about deposits because they have access to so many slush funds from the Fed, the overnight discount rate, whatever, reverse repo account, whatever they want. They've got, they can, because of all the repo facilities set up since 2008, JP Morgan doesn't need deposits. They can access liquidity anytime they want. However, smaller banks in the US can't have that luxury. They need deposits. And the problem is a lot of these banks are apparently not very well run. So the Fed starts raising rates, they get greedy. They don't, if you got a deposit account with, whichever regional bank, and you're getting like half a basis point, like 50 basis points, and meanwhile the Fed funds rate's 4.5. So the Fed keeps raising rates, but your bank isn't increasing deposit account rate. You're getting crap. Who's making that money? What's the bank? They're trying to arb you. They're not paying you a sufficient deposit rate. And well, that's okay for a time being, but then when smart depositors say, hey, there's a money market ETF that's investing in treasury bills, and the treasury bills are paying 5%, why the frack am I keeping my money at this bank and earning nothing when I can go put it in an ETF and make 5%? And it's a short-term ETF, and so it'll roll off every 30 days or 90 days. And it's a treasury bill, so it's government guaranteed, so it's even safer credit-wise than the stupid deposit. So what am I sitting doing this in this crappy regional bank deposit account? So that's what's been a pressure for the small banks, is they've been seeing deposit outflow, and because they're stupid enough that they haven't been raising their deposit rate, they're seeing cash liquidity issues. And so and the other side of the coin is they're not earning enough because the economic climate has gotten, the outlook is worse. We're looking for a recession sometime down later this year or next year. And so, yeah, bank lending is slowing. So you're not getting enough revenue.
And people's deposits are lowering and lowering and lowering. No one has some money to put into these accounts because of inflation as well.
So
they have no choice but to raise rates to fight that. So Feds are in between a rock and a hard place, big time right now.
Yeah. So anyway, to finish the story, I mean, you've got all these small banks that are losing deposits, and they're feeling liquidity crunch, and the Fed is draining liquidity through quantitative tightening. So the Fed is selling bonds, so the price of those bonds are not getting better, and the Fed's talking hawkish. And of course, after last week with Powell going super hawkish, saying, "Oh yeah, terminal rate's not 5.5 anymore; it's probably higher," because he's got to talk hawkish because they have no credibility. They need to be seen that they're fighting inflation. So the Fed is making the problem worse by draining liquidity and talking hawkish. So all of a sudden, it's like, okay, I'm losing deposits. I don't have enough money. I got to sell some of these damn bonds. Oh, geez, so SVB sold about 27 billion of bonds. They only lost, relatively speaking, only 2 billion. So they took a 10% hit, but they probably sold the bonds that they could probably, they probably sold some of their shorter duration bonds, which weren't as big a loss. So yeah, if you look at, and this is the funny thing is, like, when this came out, it's like, well, why are they selling bonds at a loss? Oh, because they're short cash. Well, and then of course the natural inclination for someone seeing this and saying, oh, well, we should sell this bank stock. Then, like, well, which other banks? And you take a look, the FDIC came out with a report, and everyone's been throwing around Twitter. It's like showing the graph, like the hold to maturity losses on some of these. Like, I think Bank of America's got 116 billion, JP Morgan's got 40 billion, and Citibank's got 50 billion. Whichever the other big bank I'm forgetting right now, but they were all like the of the big four, it was like 220 billion.
Bank of America, did you say?
I think I missed that one. Bank of America's the big one though.
Yeah.
So yeah, like the people are noticing, well, if it's not just this stupid Silicon Valley bank, it's a lot of these banks. So you started to see a contagion trade on Thursday where the entire regional bank sector got nuked, and even JP Morgan and the other bigs initially got nuked, but then. So here's the thing. As I said, JP Morgan, they don't really need the deposits. So it became like, okay, well, and we can get into this like later, but JP Morgan, in fact, was seen trying to poach deposits from, Silicon Valley. Now, the other part of it, all this problem is, like, apparently, and why some people on LinkedIn are saying this is an isolated incident, is because Silicon Valley Bank, apparently what started it was a lot of the venture capitalists in Silicon Valley and some of the funds that advise them were saying, hey, take your money out of Silicon Valley Bank, not any other bank, but take it out of Silicon Valley Bank and put it in JP Morgan. So this was a bank run, and you could almost trace it back to JP Morgan and other big banks trying to cause like a destabilization event here. And so yeah, like if you got to take Bill Ackerman's tweets with a little bit of conspiracy theory here, because like he's advocating for some sort of fix, like JP Morgan coming in to buy them out. So this is probably exactly what JP Morgan wants, right? It's like JP Morgan.
Oh, for sure.
Yeah, no, and it's
Did
insidious.
you see all the influencers suddenly go to JP Morgan? JP Morgan, Kramer talks it. Meet Kevin suddenly talked about it. It's a hard push to get out of these small banks to get into these big banks, because I believe that they need liquidity as well. I know you're saying that they have a lot of access to it, and of course they do, but I feel like they still need those deposits. They have about 50 billion in unrealized losses.
Yeah. Absolutely, and that's the thing. It's like the traditional thing is they don't need deposits, but and all of a sudden they do need deposits, or they so otherwise they wouldn't be trying to poach SVBs. So like it just
offering 4% interest rates on accounts like they're offering.
Yeah, and that's a big clue, right? It's like all of a sudden they're being attractive. Like in Canada, it's a little different. People have asked me, "Is this going to happen in Canada?" And I'll just briefly sideshow that this. So in Canada, it's been different because the big banks love deposits. Part of my job is to manage a large amount of funds, and I do get banks, aggressively chasing me for deposits. So it's like, okay, we're going to pay you every time the Bank of Canada raises rates. We're going to actually increase our rate on your deposit account, because otherwise we know someone else will, and you'll take your money out. So in Canada, the banks are more. They have been more responsive to rate hikes, and so their deposit rates are more competitive. And also in Canada, OSFI, which is the regulator here, is very active in monitoring capital adequacy ratios. And what happened at SVB and their duration bet in their bond portfolio, that I wouldn't say that can't happen in Canada, but it's not as likely to happen just because it's monitored more closely. And having worked at Scotia, and my job at Scotia was to get in, like I was the deposit specialist at Scotia. So for Western Canada, my job was to get people to bank with Scotia. So we were very careful about trying to not lose deposits. So it's all very like, and we can get these things from a Toronto Treasury group saying, oh, we need Treasury, more deposits. We're going to offer this product because we need to entice people. And it wasn't just the institutional guys; we were also targeting retail. So it's like, oh, we got to have the, Joe Public. We need his money as well. So anyway, in Canada, I don't see this being a problem. So everyone in Canada, just relax a little bit. But that being said, if you have a big enough systemic risk issue, like Credit Suisse going down because of this, then anything is possible. But mostly the Canadian banks are okay, I think. But some of the smaller banks in Canada can't say that. And anyway, you can go back to the main event now with JP Morgan and everything. But I just, because I had people asking me about Canada today.
No, you're good. And now you talk about Credit Suisse, which is one of the things my next question was going to be. So they delayed the report. Do you believe they delayed that report because there could have been another run on them as well, and they couldn't have contained both them and other bank collapsing?
Yeah.
Along with Silvergate.
There's no good news coming out from Credit Suisse. Like the share price and the CDS is obviously indicating there's an issue. Nothing, and we were talking about this even last call we did months ago. It's like they're a dead man walking, and once you lose, like the reason Silvergate had to close is because they lost public trust, and Credit Suisse has lost trust. What I can't remember which fund basically took out all their money out of Credit Suisse. I think it was significantly, it was in the billions or something. So that was like an indication, like you're going to have a bank run in Credit Suisse. People, like, they were able to get the Saudis to come in and bankroll them several billion, but I mean, the share price hasn't rallied at all since that happened, and they've been trying to parcel off more parts of their business. And someone was pointing out they closed a few facilities at the CDS the other day, so they're clearly downsizing, and to me, it's a dead man walking scenario. So this event that's been going on this week, whether the Credit Suisse issue was directly tied to that, or whether the Fed said just, oh my God, yeah, we're seeing some pressures build. The last thing we need is you having a crappy report after Silvergate says they can't report their balance sheet. So why don't you try and fix something? And I don't know why the regulator decided to, the SEC was it? Yeah, they decided to give Credit Suisse a little bit of a break, but they're not going to be able to produce anything that's going to be encouraging anyway. I mean, it's just, I think it was absolutely just to dampen the bad news, try and prevent Silvergate feeding onto Credit Suisse. But then this thing came out.
They also closed their mortgage-backed securities division. I don't know if you saw that.
No, I didn't see that, but that makes sense. Yeah, it's this. So here's the other problem. I love the fact that in the U.S., if I was a U.S. homeowner, I would take huge comfort in the fact that I have the ability to renegotiate my mortgage when interest rates are pushed down to ridiculously low levels. I can lock in a 30-year mortgage at like 2%, and then I'm laughing. Uh, especially if you're like paying 5% and now you're only paying 2%, that's a huge savings, like 3% off whatever 500,000 or whatever your mortgage is. That's a huge benefit to the homeowner, and that's a good thing. But the problem is that the banks don't seem to manage this risk very well, and so you were basically had a mortgage portfolio where your client was well, what happens is they typically sell the mortgages off to a refinancer Goldman, who repackages it into MBS anyway. But so basically the risk is that the homeowner refinances by when you have a big drop like that. So okay, I've basically sold, got out of my mortgage and I got a much cheaper rate. But the guy that was holding your original mortgage in that mortgage-backed security, well, whoever's owning that mortgage-backed security is just taking a hit because you've prepaid and refinanced, and so that mortgage-backed security will take a loss. But who's been buying these MBSs then? Okay, it's been dumbass banks like SVB. So that's a big problem.
And the Fed's the number one asset.
And you look at that, and I mean, here's the other problem. Yeah, I mean, we can go like I've been trying to keep up with SVB. There's so much noise on it right now, but the when people say there's not going to be a contagion from it, because it was basically just the venture capitalists were caused a bank run by the advisors telling people to get their money out, but it won't affect the other banks, and the American system is well managed. But the problem is that even if that was true, and again, with some of all regional banks, I don't believe that's true. I believe they'll be subject to some bank run panic anyway. But this case with Silicon Valley, it's like there's huge unintended consequences. Like Roku apparently has 500 million there. The USD stablecoin had 5% of their assets wrapped up in there. So the stablecoin lost its peg on overnight. I don't know where it is now, but I mean, it dropped from apparently 1 to 90 last night. So there's going to be lots of, in the Silicon Valley startups, there's a whole, and again, Bill Ackerman is alluding to this too. There's a whole thing about like these startups were forced to take loans from SVB and they had to keep their money there. So they had no choice. And so now they can't afford to make payroll. And this is disastrous for the startup industry, and it's going to set U.S. tech back decades and blah, blah, blah. You can't make fun of it, actually. I mean, it's serious.
No, I think it's insanely serious. And on top of that, you're killing them again, your middle class, which is where your entire economy, everything's based off ciphering from the middle class.
Yeah.
So it's going to be a big deal.
Yeah. My big concern here, and again, it's like we can bash JP Morgan, and it's like if there's any kind of real, like I said, they were poaching deposits. So JP Morgan is clearly not innocent here. If you're basically taking your big banks who are able to get all this federal assistance, and then they go out and they basically try and sabotage smaller banks and take them over, or get rid of the competition. This is just exactly the analogous to Citadel going after a cancer company and taking them out. It's like you're not benefiting society this way. You're benefiting your P&L, but it's a long-term detriment to society. So these big banks using federal, like the ability of the Fed and all their liquidity and the repo market to go in and take out vulnerable competitors, it's not a good thing for the U.S. economy. It's not a good thing for the global economy, I don't think. So that's my big concern is if that kind of thing is true. It's like, yeah, especially if Bill Ackerman gets his way and JP Morgan or Wells Fargo, that was the other bank I forgot about. Anyway, if they go in and buy these distressed banks, it's like you're just feeding the problem. You're just creating a moral hazard for these banks to go and destroy the rest of the banking sector. And again, as you said, it's middle class people that mostly use these banks. It's not the institutional players. And that's the only difference here. In SVB, apparently had like majority of it was not like your Joe Public. It was mostly institutional funds, or it was venture capital funds or whatever, who are typically well off. And they said only about 7%, I think, of their assets are FDI insured. So yeah, like there's a lot of people that would be okay because they probably didn't have more than 250 in the bank, but then that's not the majority of the people in that bank. It's like there's a lot of I had people messaging me, oh, my friends, they have like 12 million and they took 6 million out. They still have 6 million exposed. I mean, that's not your average person, but there's a lot of above average people, like call them lower upper class, whatever you want to call them, that they're going to lose millions here. Is that a good thing? Because if these are the people that are generating, again, these are the future Yahoos and the future Googles, and they're being taken out, that's not good for the U.S. economy longer term. So I'm really concerned at the moral hazard that J.P. Morgan and I mean, I know you hate them more than I do, but I do think that this is a big issue. And if the Fed encourages this behavior, then that's not good. Just not good at all.
No, I agree. The next question I got here is kind of going into that. So, in the United States, what do you see going forward? Because the Feds are talking about another 50-point raise, and if that happens, you'll put a lot more pressure on these type of banks. There's a reported 500 billion in unrealized losses in the banking sector currently through these bonds. And like you were saying before, a lot of these bonds, because of these categories, they're able to exaggerate how much money and how much collateral they actually have, along with the supply chain through supply chain refinancing, because the banks are able to create collateral that has been destroyed too. So what do you see going forward with the Feds, or how do you see them combating inflation? Do you think they're going to keep going through with the 50, or do you think they'll go through with the 25?
It was interesting. So the market had a complete 180 last week. So when Powell started speaking on Tuesday, the market went from pricing in a 25 basis point hike to pricing in 50 this month, and then another 75 later in the year. And a chance of a pivot this in 2023 was completely taken out. And then Wednesday he reiterated his comments, and that just got more exaggerated. And we saw, but that's when the banking sector started to puke. So the banking sector didn't like the idea in the first place that the terminal rate would be higher. And the problem was that Powell was again being like ridiculous and saying, well, he wasn't defining how high the terminal rate would be. It was like, yeah, we were talking about a terminal rate of 5.5, 5.25, 5.5. Well, now it's going to be significantly higher, and it's going to be, we potentially rates going to be higher for longer. That's very nebulous. He's not really giving any kind of defined path there, and he can't, because it's not like a Fed meeting where they got a dot plot and they have all the forecasts. So he's basically just responding to questions. But unfortunately, that hawkish talk is unnerving to someone that's already got a huge bond portfolio underwater, and so yeah, like as the bank stock started to puke, and especially after SVB started to puke, that expectations for hikes changed dramatically. With Nutso on call yesterday, when she pointed out, 10-year Treasury dropped 5% yesterday afternoon, and no one's really talking about it. So yeah, like again, the 10-year Treasury was at over 4% again, which again is my sort of demarcation for financial Armageddon. And then by the end of the day, it closed at like 374. And if you look at the entire curve, it did a complete meltdown. Like the expectations for hikes have changed. Like the futures market now is saying there's like a 25% chance of 125 basis point hike this month. So you went from 50 guaranteed to less than a half, less than 50% chance of 125 this month. And yeah, like the pivot now is back on the board. And here's the biggest problem. People might wonder, why are these banks holding on to these losses? Why didn't they sell some of these bonds earlier? When, like, the problem is that the Fed has been playing mind games, and the data has been playing mind games. So that when the Fed started hiking aggressively in July, the curve went inverted. So basically the 2 10 this is a typical spread. The two-year 10-year Treasury spread went negative, an inverted curve. And typically, an inverted curve in every historical precedent has indicated a recession. So people see that spread, and it gets wider and wider, and it got to like 110 basis points early in the week. It's like this economy is going to implode. It's going to implode hard, and there's no soft landing, and so the Fed's going to have to pivot. So people saying, okay, I've got these losses, but the Fed pivoting means that they'll start cutting rates and quantitative easing again, and therefore these bonds are going to get back in the money. I'm not going to sell them until they get back in the money. And that's what I think happened with stupid SVB, is they kept banking on some sort of recovery of their bond portfolio, and it didn't happen, because every time the pivot talk gained power, then Powell would come in and talk hawkishly again, or you would see the data come out stronger. Like the last 5 non-farm job reports have all been higher than expected, and January in particular was a lot stronger than expected. And in addition to that, the price data, like the CPI data, Yellen was doing victory laps 2 months ago because like disinflation is happening, the inflation rate's going lower, and then the last report was not so rosy, and then you had other costs like the personal cost index, purchasing cost index, sorry, for purchasing managers, they're all up, and there were revisions to previous CPI numbers that were up. So like, and that combined with Powell's talking is basically nuked any talk of a pivot. So now we're back. The pivot is sort of maybe happening later this year, but meantime, these bond portfolios are just impossible to manage, and these guys have so many losses. So that's where I think the Fed is probably, before this all started this week, I think the Fed was going to go by 25 anyway. I think they're still going to go by 25, assuming there's no contagion. If there's a contagion, and that's not, there's a possibility there'll be contagion on Monday, then the Fed hiking at all might be put to question. So it's a very challenging market, and I joked I don't think Yellen's going to have a very quiet weekend. So to that effect, there is a rumored, I saw this a few tweets on that. There's supposedly an emergency Fed meeting on Monday morning. I haven't checked the Fed page to validate that, but if they do have one, and we recall last year there was several, and people got all excited about, the Fed's going to do something, and nothing happened with those meetings. So even if there is a meeting, it might just be a typical like closed book administrative meeting. But if it's not, then I wonder what they're going to do. Like, again, Powell's not going to come out and say, last week I was wrong, now I'm going to start cutting. No, they're not going to do that, because his reputation's already in tatter. So what I think he's going to do, they're probably discussing this whole situation. The one thing that people forget about is there's $2 trillion odd in the reverse repo account. Now, that doesn't directly address the bank problems exactly, but it would be liquidity. It would there's the problem is that stupid reverse repo account is paying, if Fed funds is, what is Fed funds, 450 right now? It's paying 455. So you're being paid more than Fed funds to put your cash at the Fed, guaranteed, no credit risk, So they need to cut that rate. They need to cut that rate to get some of that liquidity out of the Fed and into the market. And that's always sort of been like the thing I've been talking about. We won't see a bottom in this market until that $2 trillion goes to work. So that's what I'm thinking they might do, but we'll have to see.
Yeah, I agree with a lot of that. The next question, kind of going in on that, was going to be, well, what you're probably going to say about the reverse repos on that. I was going to say, do you think that these unrealized bonds that are going to start hitting because the Feds will not be pivoting, and do you think that could be the domino effect right there, or start the domino effect?
Yeah, and I think it already has. Like I said, the fact he was overly hawkish and talking about increasing the terminal rate and not defining what that terminal rate might be, and saying higher for longer because we're losing the fight against inflation. That's all very bad for those bond portfolios. And and now the tension was that the FTC brought to light that, look at these banks, how much they have on these things. So it's like, I think there's going to be some serious looking at, do we sell some of this now to get liquidity, or do we wait and even taking bigger hits? Because like I said, the Fed's not backing down on their hawkish talk, and the inflation's certainly not going down. So there's no, again, it's the only reason we'd see a pivot here is if the market melts down. So again, it's like, it's kind of, I'm not sure how I define it. It's like the Fed will not stop talking hawkish unless the market melts down. but the market's going to melt down if the Fed keeps talking hawkish. So it's just what part of the chain breaks first, I guess.
No, that's exactly. I agree. That's why I say they're in between a rock and a hard place because they're still printing money. They're still stealing. They're still stealing in Wall Street. So the problem's occurring every day still. So it's not getting addressed and just raising rates. Well, by doing that, you're also squeezing your middle class because you're making it harder not just for these companies to borrow money, but you're making it harder for us to borrow money.
Absolutely.
You're making it harder for us to go get mortgages. And that leading into that is my next question. With rates continuously going to rise. And people, as you already saw, 40% drop in mortgage applications from last year. Do you believe that there will be a housing crash in the United States?
Yeah, that's a great question, and I'm seeing a lot of people pointing to that stat that you're talking about, and it's so. As I said, I was under the comfort, I guess, that I knew a lot of U.S. homeowners had refinanced their existing mortgages when rates were low. And you don't have the problem that we have in Canada where every 5 years you have to renegotiate your mortgage. So there's a reset risk in Canada that's not necessarily there for the US. However, the US economy is addicted to housing. And if it's not the people that already have houses, it's the people that want to buy houses. And the entire housing industry is built on an expected a number of houses being sold every year. And if the housing affordability goes through the roof and you can't afford to buy the house, then there's a lot of inventory that's not going to get sold, and then there's a lot of jobs involved in the housing industry that will get laid off. It's like, hey, we don't need you, we have too much inventory. So yeah, like good luck. And those guys, well, girls too, but the people that build the houses, well, then they're spending their money at Starbucks or wherever they're doing with their money, and they're going to have that money to spend. So it's a knock-on effect to the entire economy. The U.S. economy is very much dependent on housing, and so yeah, like a slowdown in new houses being sold is going to be a big problem. So again, I think there's a certain portion of the U.S. that's fine because they've got long-term mortgages at low rates, and that's not, they're not going to be subject to this problem. But as you said, there's already knockoff effect on houses being sold, and that's only going to get worse because interest rates, as Powell said, are not going to go lower. I mean, you've got kind of a weird situation where the curve is inverted. So you've already seen sort of the top end of the longer term rates, but the damage is done. So the fact that U.S. mortgage rates went sky high a year ago or 6 months ago, and that's being felt now in new housing sales, which are not happening. So you need to have the curve invert even more. You need to have like the 30-year mortgage rate drop dramatically, and that if the market may actually do that if they feel like, yeah, this is not sustainable. We're going to be crashing. That's the problem with all these numbers that's coming out from the BLS. It's like, do you believe these numbers? Do you believe the inflation numbers? Do you believe the job numbers? I find a very hard time believing the job numbers when I see all these layoffs happening. And yeah, like again, we're however much Silicon Valley contributes to job and wage pressure, there's not going to be any wage pressure if these startups are all laying off people. So there's the other thing is people talk about, well, there's like you get your when you're laid off, you get your 3-month severance or whatever you got. So the impact of a lot of these tech layoffs haven't been even felt yet. So it's like I feel I usually with calls with Nutso, I usually equate it to like the Fed has created a big hole in the highway down the road. You don't know exactly how big it is or where it is, but you know there's a hole, and you're just driving carelessly into that hole, and you won't know how bad it is until you hit it. And that's, I think, what's happened is and the market's pricing in that hole, but we don't know how bad it is, and that's the problem. So.
No, I agree. Yeah, I think if there's going to be a crash in there, it's because the median house is about $2,500 a month now, and obviously not many people have that on the side. Along with, you look at automobiles, the average is about 700. So just between a car and a house, you're already paying over 3,300. That's not counting insurance, utilities. So that's the only reason why I could see that crash coming there. And a lot of people that are selling houses, they're not able to actually sell them right away. And another thing I was looking at is you're seeing a lot of these people in these luxury type buildings, they're not paying any of their rent as well. So a lot of those are just going to be going, dropping hard too. So, a lot of people ask me that too, but I think that the price houses or the housing prices will drop, but I don't think it's going to be a massive crash. But going on to the next question was United States economy. The next thing told me you wanted to ask because you see everything's now being exposed as a Ponzi scheme, and everything's created to be liquidity, and everything seems to be running on credit. Do you see a crash in the United States coming, or
Yeah, I mean, it is. So let's back up and think about like 2008. Um, it was a completely different structure. There wasn't enough regulation. There wasn't enough safety bumps. Um, Therefore, like yeah, one event led to another, which led to a near meltdown of the entire global economy. As I said, the regulators have tried to put in things like liquidity buffers for the banks and stuff. There are, again, the repo market is the repo facilities at the Fed are there for liquidity. So a lot of the contagion effects should be moderated, which again should then not, like, you shouldn't have a mass meltdown of the economy, like, and certainly not anything like 2020 in March, where the half the economy slowed down. So there's not going to be a cliff thing, but it will be a down. I think it will be how should I put it? I do think the economy is going to go slow down dramatically, but it's like a cliff versus a 45-degree incline. I mean, it's not 90 degrees, it's 45 degrees if I'm getting my math right. So yeah, I do think there's going to be a big slowdown. I do think it's going to be painful. Uh, it will probably, again, housing sector, as we just talked to, is probably going to be a big component of it. But um, yeah, I I guess I just don't know how bad it's going to be, and I don't want to be doom and gloom. And again, it's just like we're talking about with SVB. It's like I know there's going to be contagion effects. The people that say there's no contagion, it's an isolated event, they're wrong. I just don't know how much contagion, and that's where I know the U.S. economy is going to slow down dramatically. But how is that going to be, like, negative growth, or is it going to be like zero growth? Um, I will say, yeah, because of all the, what do you want to call it, the Ponzi scheme. Like, it's been very hard to, like, there's been distortion of economic capital, so it's really hard to know how many, like, zombie companies will finally get nuked. Will any get nuked? I mean, it's like, how long can you keep it? The thing, I guess what I'm thinking now is, because things like these bond losses are coming to light, it's like the cost of subsidizing the market with overly generous liquidity is finally being shown, and I don't think doing the same thing over again is the right solution. So like Ackerman, I think he's just like saying, yeah, let's open the 2008 playbook again. It's like, I don't think that was the right solution. I think SVB should just let the crash and people get suffered. No, I think they really, like, the FDIC is probably doing what they're supposed to be doing, but I don't think if that's that probably won't be the correct answer. I think there is a case to be made for doing some kind of intervention with this bank crash. But if they don't, then yeah, like, again, it could feed off multiple side effects that, again, regulators, in my experience, are not very good at anticipating unintended consequences. So I think the unintended consequences of the crypto space melting down and stablecoins, and again, they want the crypto space to go down. The authorities want the crypto space to go down. So, but I think they don't know what will happen in the aftermath. And FTX blew up, and look what happened. We exposed tokens, right? It's like that was an unexpected consequence. So there's all kinds of things that will happen, and I don't know. For that reason, I don't know how bad the economic damage will be for the U.S. economy.
thank you, thank you. A person wanted me to ask, do you think crypto? That's so funny. Do you think crypto's a good hedge for the dollar if there is a crash?
Yeah, like, that's always the standard, like, Bitcoin, is the reason, like, the dollar is untrustworthy, fiat's untrustworthy, go into crypto. I don't, I've been saying this over and over again for 3 years, 4 years. Tether is a poison in the crypto community. I believe Tether is the reason a lot of cryptos got pumped. It is like, I find it fraudulent, and everything I've seen indicates that I just don't understand how it's still around, to be honest. But I think if Tether goes, then you can have a cleansing of the crypto space, and it will probably be of value. But that being said, Bitcoin has benefited from Tether, but I think Bitcoin is solid enough in itself that it will always be around. Now that it's been, it's gotten sort of a mass. It's gotten past the initiation stage. There's the mass adopters haven't quite happened yet, but I do think it will be seen as an alternative asset. Whether it's a perfect replacement for fiat, no, it's not, because it doesn't have the qualities of money. And then that leads me back, like, again, I have a bias towards precious metals, and I did have people asking me yesterday, the day before, where should I go to get gold? And again, the gold and silver thing has its own idiosyncrasies. Obviously, inflation's been out of control, and yet gold and silver have not reacted very well, which is again kind of odd. But I do think gold and silver have a place in. God forbid, I was watching Bald Man from New York, and he had a video today about, you know, how the BRICS and everything else are going to a digital currency backed by precious metals, which is where I actually have been talking about myself. I do think China's been stockpiled precious metals for the reason that they wanted to have an alternative to the dollar that was backed by something real, which is commodities. So if you have Saudi Arabia going into the BRICS, and you have other countries that are basically going to offer something to a commoditized currency basket, such as crude and food, and then I think that's a threat to the U.S. dollar. And even a digital U.S. dollar will have difficulty competing with an alternative currency that's actually backed by something solid like a precious metal. So I think that's what's going on, and that's in my mind the bigger threat is not so much Bitcoin. Bitcoin will be around, but as an alternative fiat, it doesn't serve a perfect replacement. So I do think a digital currency will replace the dollar, and it will have to. If the U.S. comes out with a digital currency, it has to be as attractive as something that's backed by a commodity currency. So that's my bias, and yeah, it seems that the non-U.S. like there's a lot of countries in the U.S. In the world that want to get away from U.S. influence or being so reliant on the dollar, and so that is a real and present threat. And the problem is, like, when is this going to happen? It could happen quickly, but the thing is, these things do take time. The Chinese have been trying to get out of dollar dominance since 2008. 2009. So when the U.S. Treasury Fed decided to quantitative ease for the first time, China squealed like a pig. Sorry if that's an offensive analogy, but they were very upset about that because they had huge amounts of U.S. Treasuries, and the U.S. was debasing the currency. So the Chinese initially wanted to go use the IMF standard drawing rights as an alternative, but that's a kind of it's not there's no capital market for that. It's basically a central bank currency that's exchanged between central banks, and it's more of an accounting entry. So they said, okay, that's not going to work. So we'll basically promote the renminbi, but the renminbi is, it's in trade purposes, everyone uses dollars. So why? So especially petrodollars, so the Saudi Arabian decision to let, like, back in the 70s, the Saudis said, okay, like, we will put all our revenues into dollars, but you got to protect us. So U.S. basically made that say, okay, we will be your benefactor in terms of guaranteeing security, but you will have to sell your oil in dollars. So what's happened recently, though, is Saudi Arabia said, we're going to sell China petro in yuan. So China's been basically trying to build up basically an energy derivative complex in yuan as opposed to dollars. So the problem is, if enough countries decide to start transacting oil in non-US dollars, that the ability for the US to dominate things will fall. So this is not something that happens immediately, but it is a longer term factor at play, and it's one of these avalanche things where it starts small and then just again accelerates, just like SPV was like not on anyone's radar, and all of a sudden it's bankrupt, right? So that's my big issue. Is I do think the U.S. administration, if you want to continue to pursue the path of debasing your currency by bailing out bad banks and keeping zombie companies alive with cheap liquidity, well, that has an implication for your value of your dollar. And especially if you are prevented from raising rates to fight inflation because you're going to destroy your capital markets, then the dollar has to fall. And it hasn't fallen because there's this illusion that the U.S. dollar is the only game in town, but that could change, and that's what I'm sort of expecting to happen.
So I agree, and I mean, I've talked about digital dollar and CBDCs and things like that as well. I think that they're going to try and get us to accept it through a type of a stimulus package. Right now, I think that they're kind of waiting for that type of thing to come out before they do give the economy a type of a stimulus. But I think at the way that it's going, there's no way that they can't somehow put an influx of cash back into the middle class. It's getting worse for their middle class every day. You're seeing deposits are at an all-time low, basically. Mortgages are going down. It's that we have less and less access to capital. We have less access to as long as these interest rates keep going up. So a matter of time, it's going to blow. So they're going to have to do a CBDC of some type. And the only way that I can see them making us accept it is through a stimulus, because there's going to be those people that'll take free money no matter what, and they'll run out and get that stimulus. And then that way, instead of us fighting them, what they'll do is say, they'll make us fight each other. The people that, hey, they accepted it, but you didn't, then they'll pin us against each other like they always do, red versus blue type of crap.
Yeah, and that's a lot of people made the comment. It's like, even, well, they could do a bailout of SBB and other regional banks, but they would do it through some, like, if they're not yet ready for the CBDC, but they're getting closer. But yeah, it's like, well, we would, then we would have like social control over what these banks are doing, who they're lending to, and yeah, even on a general sense, it's like you want to control people. Well, it's like, okay, you can only use this CBDC to buy toilet paper, or you can only buy from this company. You can't buy Pepsi. You can only buy Coke, because we don't like Pepsi right now. Or you can't go to Walt Disney with this money because Florida's banned from. There's all kinds of things you can do with CBDCs to control people. So ultimately, yeah, it is a kind of a, like, we can go back to the Klaus conspiracy, and I don't think it's all that much a conspiracy, right? I do think that's sort of where the authorities hope they can guide us to, and I don't think people are going to be kicking and screaming to go there. That's the problem. So they'll make us desperate, and they'll take us out of our jobs and make us dependent on, having to take this thing or else, right? And it's not going to be a gun to your head, but it'll be an economic gun to your head.
And the way they'll try and justify it is just like you said. But we can control where it's spending, so it's not like these guys are just getting it and wasting this money. It's going to good use, their bills and all these other things. That's why I think the stimulus is just perfect for them to try and release it at.
Yeah, no, exactly. It's the implications of a digital dollar are, in some sense, I'm excited. In some sense, I'm terrified, and I think the terror where is much higher than the excitement for me. I just don't see any alternative. There's no way. There's too much debt in the world. There's way too much debt in the world, and we're not going to grow out of it. They have to have some kind of reset.
And that's why it's crazy. And that's what I've been saying forever. All fiat currency is a scam. It's all a Ponzi scam, and it's all worth nothing at this point. It's worth what it is because there's nothing else available. Yeah. But like you said, everybody's in debt. Everybody runs on credit. Everything's to gain liquidity, which means that it's basically an IOU, but we'll sell it to you anyways. They do it in the stock market. They do it in the bond market. I mean, you have like you said, there's so many new categories that they allow them to create to get away with collateral that they don't actually own.
Yeah. And the funny thing is, I was watching the Heresy Financial YouTube last night, and the guy's a pure, like, he's very much about fiat and the crap that it is. But he was talking even in precious metals. Historically, like, precious metals have been money, and so, like, people say, yeah, let's get back to, like, the gold standard. The U.S. at least was backed by gold. But if you go back farther than that, when people had currency in their hands, it's like there were always, like, governments trying to, like, the Romans debased their currency many times by reducing the amount of silver in their denaries. And even sorry, I'm a history geek here, but even the Lydians back in 600 BC, it's like, instead of pure gold, they used electrum coins, which are gold silver hybrid. So there's always been a problem with even precious metal. Another example. So the best Pawn Stars episode ever, this guy brings in a huge whack of silver to Rick, and one of them is this huge silver bar. Well, Rick basically takes a drill and goes halfway through the bar to make sure it's not lead in the middle, right? So even precious metals are not immune to the fact that they may not be perfect. They could be, they could be a fiat bastardization where it's not worth what you think it is. So there's no good solution, but I do think something has to be backed by something solid. Otherwise, you just get this hypothecation from hell, as we see in the stock market. So, and it also happens in the treasury market, by the way. The same process.
Oh, yeah.
Half the treasuries in existence probably aren't really treasuries; they're just IOUs.
Oh, I agree, definitely. And that's the problem. That's why I was saying for so long, it's to the point where like you said, they either need to create a CBDC, which is insanely scary because they're going to do wholesale CBDCs. They're going to do retail CBDCs, like having your own set of money for the criminals to keep doing their stuff, and then having us where they can control every single penny we spend, every, like I said, stimulus they give out. If you don't vote for them, there's a lot of freedoms that they could definitely take away from this, but it's so corrupt that It starts at the politicians, and there's no way you can get the politicians, all of them out to the point to where you can fix it. There's no way you can, and then you got the regulators, all the regulators. Well, guess who the regulators are? They're the criminals, they're the banks, they're the DTCC. So what are you going to do? Get all of them out? Well, then you're going to have to expose everything. It's to the point of where there's no way of fixing this, and that's why I'm saying we need a reset. We need a great reset, either a
Yeah.
revolution of our type, or they're going to make the CBDC, because that is the only possible way they can keep the charade going, because everything is fake, everything is stolen. They're just numbers and computers at this point.
Yeah, and you're absolutely right about politics. So I consider Bernie Sanders a bit of a quack, but it's very interesting that, like, if you go back to the last uh, whatever presidential nominations for the Democratic Party, it's like Bernie had a lot of support, but the Democratic committee, there were emails that came out there basically the Democratic committee was plotting against Bernie. It's like they didn't want to give him a platform. So when your own party is trying to make sure that you're not there because you're seen as having views that would be like, again, Bernie's got like a whole bunch of things that would, Elizabeth Warren is somewhat the same way. It's like, let's upstage this whole thing. It's like the Republicans have the Tea Party guys, but on the Democratic side, they have anyone that wants to advocate for massive change gets sabotaged. And again, I try to stay away from politics, but Trump platformed on Drain the Swamp. That was never realistic because immediately he was being sabotaged by both his own party and the Democrats. So it's like there's really little chance of getting kind of a complete overhaul of the government because you have too many entrenched factors. And
Yeah. How do they all come in? How do they all come in making only 150K? They're not rich, but they all come out millionaires.
yeah,
Dark money.
even IOC, like, I don't know what, she was a waitress, and now I don't know how many millions she has. So
Exactly. There's no stopping it. Dark money, and that's the thing. They got the lobbyists. They have all the money themselves, and then they can pay everyone off. They can pay judges. They can pay whatever they want to do, and that's the problem. They end up becoming this mafia, larger than life empire. These bankers are the biggest empire in the history of humanity. They have more reach, more power, more pull than any empire ever. I mean, think about it. They have pull in every single country.
yeah, I mean, and I go back to history, and you look at the Roman Empire, or late Roman Republic. There were some extremely rich, basically anybody that had to be a senator had to have like at least 1 million sesterces or whatever. But the average Joe was only making like 100 or 200 sesterces a year, and Crassus apparently once said that, like, you can't really be rich unless you can afford your own legion. So that would be like 5 to 10,000 men, fully armored and equipped and fed, right? So you had this dichotomy where you had the 1% back in ancient times, and the only thing that ever happens, of course, is eventually empires fail because the graft and corruption gets worse and worse and worse. And we're seeing that with Russia right now. It's like the military has been unable to do what they thought they could do in Ukraine because a large part of it was their equipment wasn't serviced correctly, didn't have enough oil, the tires were rotted, et cetera, et cetera. So yeah, every empire goes through this, and that's like I said, the U.S. at some point is going to face a reckoning from all this. But when that happens, who knows?
Well, they already kind of are as well. I mean, look at, all of a sudden Wall Street takes over all of these companies. They get in everything. What's the first thing they do? We got to cut costs. What's the first thing they go to? Safety. Now you're seeing trains derail. They're getting Chernobyl, and Ohio got Chernobyl.
Yeah.
No one cares. You're seeing all these food processing plants start on fire more than ever. Why? Because all their safety measures are gone. Again, you're seeing oil refineries catch on fire. So, I mean, it's going to, like I said, they don't care. They're just buying up everything. I think, and I saw Citadel's holdings, it was like 400 billion or something.
Mm-hmm. Yeah.
It's like good one. So basically, Citadel has ownership in every single company ever that's trading publicly.
Yeah. And I mean, on a personal level,
and they're the market maker.
How many houses does Ken Griffin have? Apparently, he's got one in Aspen. And there's a whole conspiracy chain on that. But because the Aspen Institute or whatever was formed by the guy that helped bail out SBF. So anyway, there's all, it's like there's interconnections there. The money's spread around. It's kind of disgusting if you delve into it, and I try not to because it depresses me. But yeah, there's a lot of problems there. but Citadel's a exact example of the evil squid that Goldman Sachs was accused of being. But Ken Griffin is doing his best to emulate Goldman and beat them. To be honest.
Yeah, I mean, this is crazy. I mean, the whole entire stock market's built on Bernie Madoff's Ponzi scheme that the guy went to jail for. I mean, what is going on here?
No, exactly. It was like, oh, you're a terrible man, but hey, you had a good idea. We're gonna take it and run with it. Yeah.
Yeah, we're gonna take it and then evolve it, and then just use it against them. Okay.
Yeah. No, it's absolutely brutal. Yeah. So I mean, those are great questions. I don't have much I can sort of add peripherally beyond that, but I mean, if you got any other questions, I can try and answer.
I was like, no, I don't have any more written down here. I know you only had an hour or two, so I didn't try to grab too many for you. Is there anything else you want to go over? Maybe I can bring one or two people up if they want to ask a question.
Yeah, I'm happy for questions. If the studio audience has any questions, I'd be happy to answer.
All right, anyone want to ask a question? I'll just go ahead and request to come up real quick. So far, no requests. Right. I guess
That's great. Well, thanks for having me, and it's been say hi to Murphy for me. I always enjoy it. And yeah, we can do this again sometime. But there's a lot going on, so all I can tell people is there's no experts here. There were a lot of experts in 2008 that said, yeah, don't worry, Bear Stearns is isolated. Jim Cramer infamously said that Bear Stearns is fine, and 3 days later it wasn't. So anybody that's saying this is not contagion, don't worry about it, they're only seeing one portion of the problem. Anyone that's saying this is going to be a complete nuclear meltdown is probably getting too excited.
About AMC. They wanted me to ask you real quick your thoughts on AMC and the vote.
Oh yeah, okay. I'm well known for saying I'm done talking about the vote, but here's the thing. I'm glad I am glad it's coming to, because
it's like we got 2 more days, man, or 3.
So, like, I honestly think, based on my impressions with Antara and how this was, Adam does want us to vote yes. It would look good optically for him to have a large amount of retail voting yes, but ultimately I think Antara will probably tilt the scales to a yes anyway. I honestly think the yes is the better way to go, and of course this has been a very volatile topic. There's a lot of people, but I will point out, in my personal opinion, is that the no people seem to be like a lot more interested in pushing their agenda than the yes people. Like I haven't been going around saying on people's other posts, hey, vote yes. I mean, there are people that are doing that, and I don't think it's very productive. You abide with everyone can vote the way they want. I think if they vote no, if we do have a no vote at this point, and people interpreted Adam's comments at the meeting as being a threat. I think it's just reality. The reason APE was created was because AMC needs capital. Why do they need capital? Well, because we still haven't been able to get to profitability on revenue, but we are getting there. But in the meantime, there's opportunities to pay down debt, because debt's really cheap, with the Fed being so ridiculously hawkish. And there's also the opportunity for taking some properties off Royal, whatever, Cineworld. And he tried to, when he was negotiating with Cineworld, he tried to use APE, and they said no. So the value of APE wasn't enough. So he needed a higher value of APE, and people would say, oh, he should have sold APE back when it was 6 or 7. I would tend to ask that question too. Adam, why did you wait? Was there a perception issue that you didn't want to be seen dumping it right away? But anyway, like he sold some at $2. He sold at 60 cents, 66 cents. The problem is he still needs capital to do these like expansion plans. And if you're stuck doing it with APE because of a no vote, and he's got 4 billion APE left on the shelf, the inevitable is going to happen. He's going to sell APE, and it's going to drive the APE down to like near zero. And so anyone that's got APE is going to be stuck with a lot of low value APE that we may never be able to get out. So from my view,
and could I go on to that real quick though, Peter? And not only that, just so everybody who is saying no, just off that exact point, he will sell APE, and guess what? Those people are going to buy it at 30 cents, 15 cents, 10 cents. They're going to vote. They're going to convert it over. And now your AMC float that you're all complaining about will be over 1.5 billion.
Yeah, that's the other thing. So who's going to be buying APE at 10 cents? It's not going to be retail. It's going to be institutional players that are short AMC. And then they can ask for another vote down the road. and they can convert it, and so then the hedge funds will basically get out of their short synthetics at relatively cheap cost. So I haven't been going around accusing no voters of being like shills, but I certainly have been blocking a few of them, and that's the reason why, because I do have concerns that that's the ultimate course. So I mean, I'll get flack for even saying this, but I do think the yes vote, it will allow issuance of of AMC at whatever $50 or $60 or whatever it is, and you can rest assured, yeah, there'll be dilution, but would it be worse than what's going to happen otherwise? So I told someone last week, pick your poison, and that's really what it comes to. AMC needs money. They will be profitable at some point, I believe. Again, it's like I see that Adam tweeted about the movie rosters. What's coming out in March is impressive, and then April is going to be, as he said, there's a lot coming out in April, which makes me feel like it's pre-pandemic, is what he said. And so yeah, eventually box office receipts and popcorn, credit cards, it all should make us profitable, and that's a good step. But really, you can accelerate the process by paying down some more debt. Uh, and I think that's really what I would prefer. And I prefer he do it not with Ape at crappy prices, but with AMC combined. And again, a lot of people get excited about that particular issue, saying, "Oh, they're just going to short it back down again." There's no guarantee that. No one knows what's going to happen. I can't say they're wrong, but I can't say they're right. And that's where a lot of people are very adamant. They have very firm views of what is going to happen. And I told people, there's no way of knowing how any of this is going to happen. But I do think the conversion should cause some shorts to cover. You would think that it would, just because, again, the new QSIP doesn't matter. Well, I don't know if it does or not. Certainly, I don't understand if someone has been buying a lot of ape at $2, the person that's been selling to them, well, they've got to provide that ape at the conversion date. So I don't know. We'll see. We'll see what happens.
No. That's the thing. Like the people that go, well, the new QSIP idea just disappears. No, it doesn't. There's an obligation inside of somebody's broker that has been sold to them, and when it converts, there's still those exact number of shares that have been obligated, just at the conversion rate.
Yeah.
They're still out there.
Exactly.
And on top of that, short exempts. See, this is the number thing everyone complains about also. Oh, the short exempts, all the the market makers things, they go away. No, what happens is they go into they call the obligation warehouse, and it's still against it's a liability. It's a liability, but it's now on their books. You can now see it, and now it's against them.
Yeah, exactly.
That is what those are out. You guys can go pull it up on their financial records. They don't just disappear, and they never need to cover them. They're still there. And if they ever get margin, they still need to cover those. So those obligations don't go away. And on top of it, if you do the reverse split and AMC raises a whole bunch of money, you now have a lower float, lower debt, more money for opportunity, more in the bank. And what does that do? It attracts more investors.
Yeah.
It attracts more institutional investors as well. I'm 100% yes on the vote. And on top of that, what else are you doing? You're getting rid of these predatory lenders who have control of our finances, who are destroying us. You get these Anteras out of there. You can finally get these short sellers who control your company for the last 2 years out of it.
Yeah, exactly. And yeah, like for the obligation warehouse, people say, "Oh, they just disappeared." The problem is a lot of the case examples they're talking about, like whether it be Sears or whether it be Toys R Us, the obligation warehouse is filled with obligations from companies that no longer exist, whereas AMC assumingly will still exist. So again, as you said, this is a problem. They can't just have them existing. It's like it's notable. Like the AMC can basically say to the DTCC, "Hey, like this is ridiculous." I get again, people say, "Oh, they're AMC's on the threshold list, and Adam has done this, and nothing's happened." Yeah, I think it takes time, but it's certainly when you have a company as large as AMC and you've got these obligations that are clearly not being fulfilled, it does speak to the integrity of financial markets and rules. And at some point, the SEC, the FINRA, they have to do something. As much as they don't want to, they have to. So I think it's the negative foot on that stuff is kind of stupid, and I get tired of debating it. But it is, yeah.
No, me too. And then my favorite part is everyone who says no, the next thing they say is, "I would rather see the company go bankrupt than the shorts win." Guess what? The shorts win and pay tax free when the company goes bankrupt. Like it's literally the most contradictive fucking statement I hear all the time. Like, do you understand the stock market at all?
Yeah, no, and that's why I start to wonder whether they're paid to say that stuff, because sometimes it makes absolutely no sense whatsoever. So, anyway, that's the problem now is, even if there's a yes vote, of course we have the lawsuit, and that is a complicating factor for both sides. So someone like Antara, who had basically had a hedge position where they bought a crap load of March 17 puts, $2 and $3 puts for March 17th. When the lawsuit came out, all of a sudden they were seen like selling those puts, and that's why you had that little push up to $8, because they were basically, Citadel was having to go uh, buy all those puts from Antara. So the problem is, I think Antara then just put on some May puts. I haven't seen a 13F from them for that, but I mean, it's assumption they took off the hedge and they put on a new hedge to deal with the new date on April 27th. But then, like, the fact is that there's a lot of, like, the cost to borrow was high because a lot of these shorts were probably borrowing AMC thinking, okay, I can do this till March 14th or March 17th. But then it's like, oh, now we have to do another 6 weeks, and we still don't know what the decision is going to be. So there's a lot of uncertainty created by this lawsuit, and I do believe the lawsuit's frivolous. And we had like an independent lawyer that was hired by AMC. So there's bias, but yeah, the lawyer basically said AMC did everything correctly. So that's going to weigh into the judge's decision, and the judge's decision is going to be, again, it could go any way and say, oh, the judge can be bought. Yeah, that's a very cynical viewpoint. Again, it's a very public case. It's not like it's going to go away. It'll be appealed if one way or the other. It's going to, yes or no by the judge is probably going to be appealed. I don't know if Allegheny whatever pension fund is going to appeal a yes affirmed vote, but depends on exactly what the judge says, right? So there's a lot of not mischance. There's a lot of volatility here between the vote and the judge's ruling, and so I don't even know if APE is going to be able to trade between the vote and the judge's ruling. I haven't seen anything to say it wouldn't be, but there is a point. Yeah, if there's a yes vote, you could assume APE is going to go up. So I don't know, and I know some some Twitter people, not YouTubers, some Twitter people actually wrote to Adam and asked him about this. I'm waiting to hear back from him. So it is an interesting topic, and I said I just want the vote portion done because I've been tired of all the nonsense I've seen online. So, but then once we get to that, it's not going to calm down because then we have 6 weeks of ridiculous like speculation as to what the judge is going to do.
I agree. Sorry, I was responding to somebody on YouTube here. But I got to get going here. I actually have to get ready for work here in about 20 minutes. I got to get up there. So thank you so much for doing this. So I learned a lot. I always do when I get you on here. If you're free next weekend, we can go ahead and, if you want to do it again, I would love to do it again with you.
I'll see what my weekend looks like, but probably can do that. Yeah.
Sounds good, man. Thank you so much, Peter. Appreciate it.
Bye bye.
Have a good weekend, everyone.
Alrighty, so finish that up with Peter here. The synthetics, like I said, you guys, the synthetics are still obligations. They go into the warehouse. It is not that they go away. They don't disappear. There's still liabilities on their books. And as Peter went on before, everybody that talks about Sears and all these dead companies, AMC is not a dead company. AMC will not go bankrupt with the reverse split and with this and being able to raise cash. Therefore, their obligations will still need to be fulfilled because the company is still intact. So don't compare it to these other cases with dead companies. It makes zero sense. It is not even close to the same thing. So again, obligations don't disappear. Synthetics don't disappear. They're still on the hook for all of those. But thank you guys for listening. I do have to actually head up to work. I hope you guys all have a great weekend. I will try and go live again on Monday or Tuesday. But thanks, guys. Have a good night.